Canadian telecom stocks have been under pressure for some time now, but with the sector now showing some signs of recovery, should investors be taking a second look at the space? Joining us now to discuss is Vince Valentini, Managing Director for Equity Research with TD Cowen. And for full disclosure, the company is covered by TD Cowen, a division of TD Securities. Please see the link to the website at the end of this video. Great to have you back on the program as always, Vince.
Great. I'm thankful to be here, Greg, especially there's finally a little bit of good news to talk about. I think the last 3 times I've been here, it's been nothing but bad news and trying to explain if these telecom stocks were ever going to recover. And now we've finally seen a bit of life in the last little while. So it's a good time for me to be here.
I got to say, you've been a great sport through all the other interviews when it wasn't so pretty. So we're seeing a bit of a bounce in these names. What is going on in the space?
So there's several factors, but maybe there's been a bit of market rotation as the market's done so well. People looking for laggards or maybe looking for a bit more defensive exposure in their portfolio, and the telcos would certainly tick that box. And there's been some company-specific developments on some of these big deals that were announced last year coming to a close, and people getting a little more clarity on how that fits into the picture for some of these companies, both in terms of their balance sheet and their strategies. Things like the Ziply deal in the US for BCE closed, the MLSE transaction between Rogers and BCE closed, and TELUS announced a monetization of their towers, which they've been talking about for several months, but they were able to get that deal over the goal line and announce it a couple of weeks ago. So a bit of the company-specific stuff is helping, Greg. But by far the biggest thing is just the core wireless business, which had been the source of most of the pain for this sector for 2 years. We were stuck in a bit of a price war ever since Quebecor acquired Freedom, and as part of that Rogers-Shaw transaction, it created a new type of competitive tension in the market. And it took longer than most of us expected for that to settle down, but thankfully it seems to be settling down now. The past 2-3 months have been far more encouraging in terms of what we analysts call front book pricing, which is the advertised rates in the market for new wireless service, as opposed to the back book, which is the legacy base of 30 million subscribers. What do they actually pay? We're starting to see those come into equilibrium, where for a long time, the front book was lower than the back book, which meant you were constantly in a repricing cycle. Every time a customer went out and switched carriers or renewed a contract for a plan, they would have been moving down in price. Now we see that starting to reach an equilibrium and stabilization point. It all started in sort of June. We saw the typical behavior every quarter is the first month or so is disciplined. Nobody gets overly aggressive on promotional pricing. We even see sometimes price increases announced. But then you get to the last 4 or 5 weeks of the quarter and you fall off a cliff. Everybody starts panicking and wanting to lower their prices to make sure they hit their subscriber number for that quarter. So the month of June was the danger zone that people were paying attention to. And thankfully that last month of Q2 was extremely disciplined. It was the first last month of a quarter where we saw discipline in 2 years. And that set the stocks starting to move upwards. People thinking, hey, maybe we're out of the woods. Maybe Rogers, Bell, TELUS, and Quebecor have all figured out how to play nice with each other and find a new equilibrium on pricing. And thankfully that has continued right through to today. We're now into the very meat of the back to school season, which is one of the biggest promotional seasons of the year. Typically a high risk danger zone for wireless pricing when you would see 1 or 2 players drift off with more aggressive pricing. And as soon as that happens, the others would be forced to follow. But we are well into back to school season now with we haven't missed a beat. The prices have stayed known reasonably high and at encouraging levels, which has these stocks continuing to move higher and higher almost every week, it seems now, as people think the longer this goes on, the better visibility we have into the ARPU trend, which then feeds into service revenue, will start to turn upwards by not magically next quarter. It takes a while for the pig to go through this python, but by the middle of 2026, I think the analysts and investors in this space are starting to think, okay, finally, for the first time, we will start to see semester revisions higher, a little bit better revenue growth from the core wireless business. And as that improves, profitability, whether EBITDA, free cash flow, whatever metric you want to look at, will follow. So that's the key reason, Greg. Sorry I talked about that for so long, but it is.
No, it's a great backdrop, right? Because after everything the space has been through, what is going on in the space, right?
Yeah. Now, why did it happen is tricky. It's tough for everybody to know. I think there was a realization from the big 3 carriers, Rogers, Bell, and TELUS, the longtime incumbents, that look, there's just not much growth in this market. Given what the Canadian government has done with immigration policies, there's not a lot of new customers to chase So why are we bothering with these aggressive promotions to chase something that doesn't exist? So a bit of a recognition from them that it's better to focus on pricing now. There's two main components of revenue for a wireless carrier. It's actually pretty simple at its heart. It's volume and price. If there's no volume growth, then we might as well make sure we do better on price. The other realization was, look, Quebecor is a new entrant. They have a different pricing model. They're out to take market share, but they're willing to do it, it seems, in a gradual way. Should we be fighting them tooth and nail every quarter for the last marginal 5,000 subscribers? No, it's probably better to just let them have it. Because if we lower our price to try to match them, they've shown that they're just going to go even lower. So it's a zero-sum game or a race to the bottom. So I think Rogers, Bell, and Telus have all now realized that it's better to let Quebecor take a little bit of share as long as they don't get too greedy and no reason chasing volume that doesn't exist. That's probably all what has magically led to, after 2 years of beating each other up, where they're all now saying, yeah, let's end this price war and all live for better days.
So it feels like it can be a turn the corner moment. We've seen that in the stocks. As you said, they've been moving higher in recent weeks. Of course, there's a lot of ground to recover from where some of these names used to be, like Rogers or BC. Is this a long-term game, a long-term execution game for these companies?
Look, if this pricing discipline continues, there's a lot more upside for these stocks. I mean, they are, most of them, still significantly lower value than they used to be 3 years ago. I mean, if you put a couple numbers on it, TELUS used to be 10 times EBITDA. It's now 8.2. BC used to be 9 or just over 9. It's hovering around 7 right now. Rogers used to be 8.5. It's still trading at 6.7. So there has been a bounce off the bottom, and it may seem like that's a pretty big move in terms of what the share prices have done. But remember, in some cases like Rogers, half of the enterprise value of the company is debt. So if the whole enterprise value multiple moves up even half a point, that has a disproportionate impact on the equity and what you see in the share price. So we've only seen pretty small moves off the bottom on valuation multiples so far. If we see another 6 to 12 months of this kind of encouraging pricing and estimates keep sort of drifting higher versus lower, then I would still think there's meaningful upside in the whole sector. I certainly have the names I prefer, which we'll probably get into in a minute. Prefer some more than others, but yeah, this is not the end of the game for people. If you've been patient for 2 years owning these stocks as they went down, I wouldn't encourage you to bail out just because we've seen a bit of a bounce off the bottom. Caveat all that, just to go back to, we have to see the pricing discipline be maintained. We're watching, literally our team watches every day, monitors the websites, goes out and checks stores, see if we see any cracks in the armor. Are we slipping back down the slope of unusually aggressive pricing? Again, so far so good in back to school season. We still have another 2 or 3 weeks to get through that typical period of the year, and then all eyes will be on Black Friday and the holiday period. If we can escape that period as well with disciplined pricing, then onwards and upwards. But caveat that, as long as we don't see another step backwards in pricing, then yes, I certainly think these stocks have more room to run.